Why US bonds matter to Singaporeans. In 2025, there's a lot of negative noise around the US bond market. Some worry about America's rising debt, others about slowing growth. It may feel distant, but these moves ripple into Singapore, shaping your mortgage, your savings, and even your investments. The US government borrows by selling treasury bonds. Investors lend money, and the government promises to repay with interest. When investors demand more return for the risk of holding US debt, the government must offer higher yields. When demand is strong, yields fall. This simple tug-of-war sets the level of interest rates in the world's biggest economy. Bond yields aren't just numbers on a chart, they are the price of borrowing. If the US has to raise yields to attract buyers, interest rates climb across the system, for banks, for businesses, and for households worldwide. When yields fall, the opposite happens. Borrowing becomes cheaper. Because US Treasuries are the global benchmark, their direction heavily influences the cost of money everywhere else. In Singapore, the key benchmark is SORA, the Singapore Overnight Rate Average. It tracks how much banks charge each other for short-term lending. Many home loans today are pegged to SORA. When global interest rates shift, SORA tends to move in the same direction. That's why changes in US bond yields show up quickly in your mortgage payments. In 2025, as US yields dropped, SORA also fell, reaching its lowest since late 2022. That means Singaporeans with floating rate mortgages are now paying a little less each month. A small but meaningful relief for homeowners. But lower interest rates cut both ways. Singapore savings bonds and T-bills have been offering lower returns than earlier this year. For example, the October SSB pays about 1.9% on average over 10 years. That's safe and steady, but less exciting if you're a saver or investor in SSBs hoping for higher returns. Lower rates can support the stock market, especially sectors like REITs and dividend-paying shares. When borrowing costs fall, REITs can refinance more cheaply, preserve their distributions, and sometimes even raise payouts. Investors also find their yields more attractive compared to bonds. So in a falling rate environment, Singapore's REITs and income stocks often see renewed interest. Singaporeans also have significant investments overseas. Billions of dollars from institutions and individuals are parked in US equities and funds. If US bond worries weaken the dollar, Singaporeans spending abroad may benefit. But investors holding US stocks could see some of their returns eaten away by a stronger Singapore dollar. So even without owning a single US bond, ordinary investors here feel the impact. The US bond market may seem far removed, but it sets the tone for global money. Cheaper mortgages, lower SSB returns, stronger REITs, and currency shifts in your US portfolio. All of these are tied to bond yields in America. In today's world, finance doesn't stay in one country. It flows into your wallet every day, right here in Singapore.